Did you sort of take in stride the last few days?
Look, we took in stride, I think, the last couple of weeks where we're looking at a very technical market, a lot of traders looking to square their positions. I think there are some technicals around month end, quarter end, first half, and we thought the market had run a little too far, too fast, much faster than we had originally expected at the beginning of this year. So it makes sense that people were taking a step back, looking at their positions, and trying to think about what makes sense in terms of risk going forward. But we love this as an opportunity because we think this is a great time to be adding to risk as the market backs off a little bit.
You know, it's interesting because we talk about a number of Wall Street strategists. We track a number of them here at Bloomberg, and we know that their median, their average forecast for the S&P 500 are just about where we are right now, maybe just a little bit above.
Yeah.
What does that say in your mind, being a global equity strategist? Does that mean that we kind of just hover here for the rest of the year, or is there more volatility ahead?
We're looking forward for the next 12 months, and in that case, we really honestly believe that equities are going to be considerably higher over the forward 12 months. And so we have a target of about 1,700, 1,750 on the S&P. We're looking for about $112 of earnings next year and a 15.5 multiple. And when you think about where we're sitting today, that gives us upside both in terms of multiples, in terms of earnings, in terms of the overall index level. So regardless of where the rest of the street is sitting, we're saying right now that this is a good time to buy.
So what about the risks, though? Because a common theme we heard in the first quarter was that revenue was a little bit flat, a little bit disappointing, and in some cases actually weak. What do you see second quarter revenue earnings going to be like?
Well, I think we had a lot of overhang from the fiscal cliff, from concerns over the sequester. We had corporate management teams who were reluctant to take risk. CapEx numbers haven't looked great to date, but we are seeing a pickup in terms of the new orders, and we are seeing, I think, more willingness, especially coming out of the first quarter earnings reporting, of companies to think more than 3 months ahead, to think several quarters ahead.
Do you think the sequestration has really already worked its way through the market and won't get hit again?
We think we've seen the soft spot in terms of macro, and at this point we're expecting the economy to continue to recover through the back half of this year and in 2014. We think that companies will feel more confident about spending, both in terms of labor and overall CapEx going forward.
So as we take a more global view, because you do take a very large kind of macro view about the world markets, it comes down to those emerging markets. We've seen China take a huge hit, but on the developed side, we've seen Japan, a developed market, take a huge hit. What exactly is the place to put your money? Is it in developed markets? Is it in emerging markets? Is it just here in the U.S. or is it abroad?
We actually are getting more differentiated between our equity investments now than we had before. And we're saying, look, all emerging markets aren't created equal. Some of the noise we've seen around China has been very, very loud, and I think for some investors scary. To put some things in perspective, China's trading at 8 times forward earnings. We haven't seen these levels in years. It's at 1.3 times price to book, a level we haven't reached since 2003. So it's very, very cheap, and a lot of worries about emerging Asia, I think, are priced into the market. In terms of Japan, we have been a little bit more cautious than other parts of the investment community. We've said we need to see corporate behavior really change, not just policy noise, but a real change in terms of the way companies think about spending money and about investing in their future.
When you look at the emerging markets being cheap relative to developed markets, say we haven't seen these levels since 2008. Yeah. After 2008, we saw China really pump a lot of money into the system, something that they are now very clear they're not going to do. So where's this next catalyst going to come from? Because cheap doesn't always make a good investment.
Well, I think what we're seeing in terms of Chinese policy right now is an interest in making a more sustainable growth path. Well, a lot of people have been talking about this, but what we've seen in terms of the Shibor market over the last couple days and weeks really confirms, our core belief. The Chinese administration now is making changes that are going to benefit the Chinese economy and corporates and earnings for not just the next couple quarters, but the next couple years and hopefully the decade to come. So we'll take a little bit near-term noise. As I said, I think a lot of the bad news has been priced into the market at this point, but we need people to feel more comfortable before we have a positive catalyst, I think, to the upside.
Well, let's bring it back to our home shores here in the U.S.
Yeah.
Because we do know that the market has maybe rolled over a little bit, but it hasn't been deep. It's performed a lot better than Asia and a lot better than Europe since Ben Bernanke made that hint of Fed tapering. Take a look at this chart, because what it shows you is the S&P 500 down about, we'll call it 4.5% since May 22nd through the end of last week.
Yeah.
You see Europe, you see Asia falling much worse than that. Is the U.S. a haven investment?
I think for most of the investment community, the U.S. dollar, U.S. equities, U.S.-based assets in general have been a place they felt comfortable. And we've had very good macro momentum in the U.S. Lots on the consumer side. We're looking for more data from the manufacturing side next week. Certainly payrolls and employment has picked up. Confidence has really improved. So people are looking close to home saying, I understand these companies, I understand these assets, and I'm seeing the growth in the economy. What we need to do is get more consistent macro data from outside of the U.S. for people to feel comfortable taking that risk. But once they feel comfortable, I think, in their home market, which many U.S. investors really are biased towards, the better off I think we're going to be and more flows we'll see going into developed Europe and into parts of emerging markets.
And very quickly here, Fed tapering.
Yeah.
Is that totally priced into the market? What kind of short-term risks does that imply?
I mean, I know you guys have talked about this before, but Fed tapering is a good thing. I mean, the minute we can get the Fed to remove some of the accommodation is the minute we start to see more self-sustaining recovery in the U.S. economy. We want to see the Fed say we don't need to provide life support anymore.
Hence, you're buying cyclicals and rotating out of the defensive names like utilities.
Absolutely the case. And some of the valuations of the cyclicals look very attractive. There's some very good global stories there that I think have been under-recognized by the market.